Okay, in this video we are picking back up with the financial statements. We'll talk about the balance sheet. So the balance sheet is also known as the statement of financial position. It includes assets, liabilities, and owner's capital, and it shows that assets equals liabilities. Assets equals liabilities plus, sorry, I keep messing up here, liabilities plus equity. So it shows that those things are in balance. And I'm going to underline that right there. And our balance sheet is the best financial statement to evaluate financial condition. And I really want this to make sense. I really want you to understand this and not feel like you memorize this. Let me go back to the financial statements. The income statement is our best financial statement for performance. It really shows us our sales or revenues. Did we sell our product? Where our cost of doing business, our expenses, was it lower than our sales, our revenue? And so did we therefore make a profit or incur a loss? So while the income statement is the best for performance, the balance sheet is the best for financial position. It tells us out of our assets, how much do we own, equity, and how much debt do we have. So in this example, I'm going to add up our assets, and I'm going to come up here and use, there's this auto sum feature that's really useful in Excel. So when I click on it, it shows me which cells it's going to add up, which numbers, and then that looks good. That's what I want to add up, so I just hit enter. And then under owner's equity, I need to take the ending capital from our statement of owner's equity, and then that goes on the balance sheet. So I'm going to do equals, click on this cell, and notice the movement around the cell. That's what I want, and then just hit enter. And then for liabilities and equity, I'm going to use a formula. So I'll hit equals this cell plus this cell, hit enter, and these balance as they should. I mean, it's called a balance sheet, so those two things should balance. But now I can evaluate the financial position or financial condition, and I can see that we have $350,000 in assets. Out of those assets, we have debt of $120,000, and we own $230,000, or have a claim as owners of the business of $230,000. Or we could look at it like this. It's kind of like saying we have debt of about 34%, and equity of about 66%. And so as owners of the business, we would have a claim of about 66%, and our creditors, people that we owe money to, would have a claim of only about 34%. So we'd say we're in a pretty good financial position, or we have a good financial condition, because we have equity of, well over 50%. Not that there's one exact number, but generally having 66% equity, or about 2/3, would show that we're in a pretty strong financial condition. However, that's not the same thing as performance, right? So this might be our balance sheet, but then going forward, what if nobody wants to buy our product anymore, or they don't want to buy our services? Or the opposite, we might perform even better next year. So the balance sheet is probably going to look better and better as we have good performance. It will probably look worse and worse as we have bad performance. However, the balance sheet is not necessarily our one best financial statement for performance. So the one best financial statement for performance is the income statement. The one best for position or condition would be the balance sheet. And then our fourth financial statement, the statement of cash flows, we're not really going to do much with the statement of cash flows other than mention it. But basically the statement of cash flows just shows us cash in and cash out from all sources. So any cash coming in, any cash going out, that would be part of the statement of cash flows. And then one last thing here, why would equity increase? I'm going to rewrite the accounting equation. So assets equal liabilities plus owner's equity. And if I use that as a visual, then I feel like I don't have to memorize this question or the answers to this question. So why would equity increase? What would make this go up? Well, one thing that would make this go up is I could invest into the business. And if I invest into the business, my assets would go up, which would be cash specifically. So assets would go up. It's not a liability, it's not a debt because I'm the owner of the business. So I would have an increase to equity or ownership. And you're going to see this in one of the following videos that walks you through an example. So you'll understand this a little bit better as you go through one of the examples from a video. But just using this simple equation right here, why would equity increase? Owner investments. And go ahead and put this in parentheses as well. We have what we call paid-in capital. So capital is just a fancy word for money. So we have owner investments, or what we call paid-in capital. Just as it sounds, it's money that was paid into the business as an investment by the owners. And then the other reason equity would increase, net income. If we have net income, that would increase equity. I'm going to put in parentheses also here, profit. Net income is profit. If we have net income or profit, then we would increase equity. And then the opposite, why would equity decrease? One reason would be withdrawals or drawings. So if a business owner pulls money out of a business, that would be a decrease to equity. It's the opposite of an investment. It's the pulling out. I also want you to go ahead and write this down too. Drawings are called dividends for a corporation. So if we have the corporate form of business and we take a distribution, those distributions are specifically called dividends. And that's just really practical for you to know, even if you're not a business major. That's one of those little pieces of information that really everyone should know. And then another reason equity could decrease is if we have a net loss. So if our expenses exceed revenues, then that would decrease equity. Okay, so this should wrap up the notes, and then the next video you'll watch will be an actual example where I will walk you through recording transactions using the accounting equation. And so some of the concepts that we mentioned in these notes I think should make more sense as you go through that example.